Today, I'll discuss the key metrics that CFOs must track in SaaS models. Your board just asked for the one metric that best predicts your SaaS company's future. What will you say? Most CFOs would say ARR or growth rate. They'll be wrong. I've analyzed the key metrics from over 15 maybe SaaS valuation studies. And the metric that best predicts long-term success is not what most people think. Today, I'm revealing the essential SaaS metrics every CFO must track and which ones are actually very relevant for board decision making. A little bit about myself. I'm a finance exec in the Silicon Valley. I've been working here for 30 years and I've completed several valuation studies for SaaS companies ranging from $7 million ARR to about $72 million in ARR. Through financial analysis and comparative studies, I've identified which metrics actually drive valuations and which ones are just vanity numbers. Most SaaS CFOs, they track many different metrics, but only 8 of them, I think, are actually very important and they influence investor decisions and they advance company value. So let me talk to you about the metric hierarchy problem. Here's the problem. With most of how the SaaS metrics are being tracked today, CFOs are treating all metrics as equally important. There is this bucket called vanity metrics or vanity metrics trap. I studied a Series B company that obsessed over these metrics. Total users 2.3 million, website traffic 500,000 monthly visitors, app downloads 50,000 monthly downloads, social media followers 25,000. Board deck at 13-14 slides of user engagement and metrics. But when the investors were digging in deeper, the company had terrible unit economics and was burning cash faster than they were growing revenue. They failed to raise Series C despite the impressive user numbers. There is also the false profit metrics. Even some sophisticated SaaS metrics can be misleading. Monthly recurring revenue, it might look smooth and predictable, but it hides customer health issues and churn timing. Then if you look at customer acquisition cost, that is meaningless really without a payback period and lifetime value context. Then you look at the total addressable market. It sounds impressive, but it doesn't predict your ability to capture the market share. Then there's a North Star problem. Most SaaS companies, they don't have a clear metric or a hierarchy. They are tracking everything equally instead of focusing on the 2 to 3 metrics that actually drive the business decisions. So here are the 8 essential SaaS CFO metrics that I think are very important. And this is largely based on my limited analysis of very successful SaaS companies over the last 8 or 9 years. And here are the 8 metrics that I feel every CFO must track. There is a business health metric, which is related to net revenue retention. This is a very important SaaS metric, period. NRR measures how much your existing customers are worth this year compared to last year, including upgrades, downgrades, and churn. Now, if you have something which is 100 to 110% NRR, that's good. But anything over 120 is world-class. A case study, I analyzed 2 companies with identical $10 million ARR. Company A had 90% NRR. Company B had 130% NRR. But company B was valued more higher because investors knew their revenue would compound without new customer acquisition. Also look at Rule of 40. I mean, that's been popularized in the last 15 years or so. It's a growth rate plus a profit margin. And the ideal is to be at around 40-45%. This metric, it balances growth and profitability in a single number that investors love. Then there's a tier 2 component which deals more with unit economics that you want to track weekly. One important one I talked about is the customer acquisition cost payback period. How long does it take to recover the cost of acquiring the customer? So you generally take the CAC and you divide that by the monthly recurring revenue times the gross margin percentage. Anything under 18 months is good, but anything under 8 months is world class. Keep that in mind. Lifetime value to CAC ratio is another very good metric to look at. How much value do you get compared to acquisition cost? If you're getting a 3 to 1 LTV to CAC, that's great. But excellent would be a 5 to 1, but really bad is something around 2 to 1 or 3 to 1. Look at tier 3, the growth quality metrics. Track them monthly. Look at the ARR. What is the growth rate year over year? And then I would break it down actually by source. Yeah, I would do that. I would look at the new customer, I would look at the expansion revenue, I would look at the churn. And the best SaaS companies, they get 30 to 50% of growth from existing customer expansion. The other thing that I look at is the revenue retention, the gross revenue retention. What percentage of last year's revenue is still paying you this year? This measures pure churn without expansion masking the problem. Good is 90% plus, but world class is 98% plus, very asymptotic to the 100%. Then look at the leading indicators. That's a tier 4 framework. Look at things like sales efficiency. You know, how much new ARR are you generating against every dollar of sales and marketing spend? If you're generating over 1.2 or 1.5, you're operating well. It shows your go-to-market engine is working. Look at the cash burn multiple, net cash burn divided by the net new ARR acquired. If it's good, under 2x is okay, but world-class will be under 1x. This measures what? It measures the capital efficiency and growth. So the metric relationships at the end, they matter a lot. And here's what I think some CFOs, head of finance miss. These metrics are interconnected. You cannot optimize them in isolation. The growth versus efficiency trade-off is to be considered. I studied a company that improved their CAC payback from 24 months to 12 months. And that sounds great, right? But their growth rate dropped from 120% to 60% because they became very selective with customer acquisition. I'm not saying it's right or wrong, but it's a key insight. Don't optimize individual metrics. Look at the system together. Optimize the relationships between them. There is the other big thing, which is called the retention multiplier effect. These are companies with 95% plus gross retention that can afford higher CAC because customers stay longer. Customers with 85% retention need much lower CAC to maintain healthy unit economics. The next piece, of course, is the cash flow predictability metrics. High NRR plus high gross retention is a predictable cash flow. Investors pay premium multiples of predictable cash flow even if the growth is slow. The dangerous metric combinations we'll consider. I'll talk in terms of red flag patterns. If you have, let's say, high growth and declining NRR, there's a leaky bucket. You have low CAC payback plus high churn, unsustainable economics. If you have high rule of 40 and high burn multiple, there's an efficiency mirage that is happening out there. So here are 3 practical steps that I can share with you for implementing this metric framework. Tip 1, create a metric dashboard hierarchy. Board level, focus on NRR, the rule of 40 and the cash burn multiple. Executive level, add the CAC payback, the LTV to CAC and the sales efficiency. And finally, at the operational level, include all 8 metrics plus supporting details. Don't overwhelm your board with 13, 14 slides with vanity metrics. Show them the 3 that matter the most. Tip 2 is to track the trends, not just point-in-time numbers. Show 12-month trends for each metric. Investors care as much about trajectory more than the current state. A company with improving trends and mediocre metrics often gets better valuation than companies with great metrics but declining trends. And tip 3, connect metrics to business decisions. Don't just report numbers, explain what they mean. NRR improved to 115% due to our new customer success program. CAC payback increased to 14 months because we are targeting the larger customers. The rule of 40 hit 45% as we balance growth investments with margin improvement. Metrics without context are just numbers. So in conclusion, the best CFOs, the best SaaS CFOs rather, they don't track a whole bunch of metrics. They track the right metrics and understand how they connect to business value. So focus on these 8 essential metrics and understand their relationships and use them to drive actual business decisions. That's how you move from being a scorekeeper to being a strategic partner. Remember, Investors don't fund metrics. They fund the business strategy that those metrics represent. All right? So thank you for your time, and I'll see you in the next blog.